Thank you, ladies and gentlemen. We're in the business of helping people to to be financially free, and it is, as Walter has said, information out there, but not that many people understands that the biggest asset that you have is yourself. And if you understand that, you will understand that there's a what we call a personal economy, and every one of us must understand that you know there's an income and an expenditure for each household, and there's the money we spend is by current decisions, past decisions, or decisions that impacts the future. But at the end, we need to channel it into growth assets. So the idea is for us to say, well, if you've got nothing, but you've got a paycheck that works, then it actually makes the difference for you to in property. And we hope to impact you tonight to actually show you that you either go into cash and investments in your stock of your business, if that's your line, or you go into investments which is property, businesses that you can into and growth assets. But I think the reality is that you either build cash or assets. And property is the biggest and well-known one of them all. So that is very important for us to understand that you can actually manage your own um, wealth creation process from day one. So I think, and I've researched this, in South Africa, people don't understand at the end of the day, capital and income preservation pillars that we need to build our future wealth on. And if you look at it, you don't need to lose your capital. And many people come and they get a package from the state and they do an early retirement, they buy a business, but they forget about the fact that their capital took them 30 years to build up. So capital preservation and not taking risk to lose it is actually one of the most important factors when you build your wealth for the future. If you look at the income portion of what your capital, so doesn't property portfolios, business portfolios, an asset is only an asset if it can produce an income. So, but the reality is we need to outperform inflation. If you don't outperform inflation, I'll show you now what the effect is, because your buying power is actually then getting less every year. So in a country like ours versus America and, well, nowadays London as well, where you had 2%, not a major factor, but where you have an inflation on our levels, then you suddenly realize it's actually critical that you protect the income flow. And if it doesn't keep up, and I'll show you on a slide just now what it does. So in financial services industry, there is basically a principle called the rule of 72. And it's a very simple one. It's different. There's actually a rule of 73, a rule of 70, a rule of 69.3. But the reality is, to keep it simple, we take inflation. So if the rule of 72 is applied, I want to show you how long does it take power of your money for every rand to half. And what you do is you take 72 divided by the inflation rate. So if the inflation rate is 4%, it will take you 18 years for your money to half in value. But that's not South Africa. That was like last year for a short while. But now the current inflation rate up 0.9%, which means for every rand in 10 years, it will be almost 55%. So you only be able to buy. What does that mean for you? It means that if you invest, you need to invest at a rate higher. So if you invest 100 Rand, you get 1% growth a year, you'll have 101 Rand at the end. But if inflation is 2%, you need to get to earn an interest rate of return of 2% to be on the same level as you've been at the beginning of the year. And that is the effect of inflation. So inflation is actually a very important principle for financial planning. So I want to show you that if the inflation rate is 6.9%, that means that in 10 years' time, the same rand you used, you will only be able to buy half a bread. So that is so, think about it. You get people who retire at 65, and then at 75, they say, listen, I was so well off when I retired, but now I'm struggling. And this is the reason. Because retirement, the inflation of a retiree is actually much higher than 6.9%. And that's why you find when they get to age 75, they actually struggle. And I can show you this slide. It's just a simple example. It is an actual 1 million rand investment. You take monthly income. We made it 8,333 rand per month because that's a 10% of your capital that you withdraw. The inflation rate is done on 6.9, and we assume that the fund that you're investing in is actually growing at 12.9%. So what I want to show you is, first of all, you'll see the 833 is growing with inflation, 6.9%, otherwise survive. So in 10 years' time, you need to earn 15,000 Rand. In other words, in the 11th year, 16,000 Rand to have a full bread still in your basket. If you don't keep up, that means your bread is getting smaller and smaller. You know this, the bar one, what, did you see the size of the bar one, the Coca-Cola bottle key? You know, they're all getting smaller. This is the reason. It's getting more expensive. So what we need to understand is that after 10 years, you will see that you suddenly start to use some of your capital to keep up your lifestyle that you need. And that is where the key is. So that means in 17 years' time, you will have left. So that means if you are getting older than 82 years, you'll actually be without money. And the clever guys are saying to us that every person that is now 50 years, one of that married become 90 years. So that means there is a trouble come. And I mean, you know how much lifestyle costs. So 8,000 Rand a month is almost the minimum these days that you can withdraw. So what I just wanted to show you is that it is actually very important for you to get an investment vehicle that will outperform the inflation rate of 6.9% on your income level. You have to invest to actually keep up with that. And secondly, your fund that you actually, the underlying asset needs to actually grow higher for you to not go into that cycle of having a dip in your capital and run out of money by the year 17. So that is just the impact that I wanted to show tonight, because we're talking about an asset class called property, and why the products that is on offer by the Assist Group can actually really make a difference, either planning for retirement or actually getting to using the money to make sure that you actually get returns and higher returns like that, what you will need. So I think that's basically it from my side. I just wanted to do a short introduction because financial planning is actually the key, and we as Assist Group focus on planning from a property perspective for each of our clients. So thank you very much. Okay, so Arnie, you'll introduce Neil.
Thank you so much. Neil, welcome. Thank you so much for your time. I have to read Neil's CV tonight. I'm going to use most of my time, so I'll be very careful with that. So I have to look for the key points. And I think, first of all, I just want to say, those of you who don't know about the Real Estate Investor magazine, and your plan is, or you are currently a real estate owner or a real estate investor or a potential real estate investor, this is definitely not negotiable. And first of all, you'll find in our document today, and obviously for the guys online, we will make it available as well. We'll send you the necessary registration forms for that. Link to, and I thank Neil as well, because a lot of the Real Estate Investor magazine clients are also attending online today. So thank you very much for your time. So just about a few highlights. Neil is the founder of Real Estate Investor magazine, and that magazine is the SA's leading digital real estate content platform with a worldwide audience and a reach of over 300,000 people. So it's really worth it. Guys, I'm going to not go too much in the detail. We will supply this information to you as well online. But I'm going to specifically ask, speak about Neil has got on his CV, and it's his media experience stems from Naspers in the past, just to give a bit of background. But the highlight which I will want to touch on is more the interview highlights, includes a real estate mogul and ex-US president Jack Wells, Robert Kiyosaki, for those who are in the property industry, Christo Wiese, which I don't think need any introduction, Dr. Dolf de Roos, who's in the financial market, Saul Kersner, John Smith, Johan Rupert, Kim Kiyosaki, and Ryk Neethling, amongst others. So I think he really talks to a lot of people about property investments. His real value is connecting all these people together, sharing that specific information. And that for me is my heart and my association with Neil, as his purpose is to inspire, educate, and empower investors and entrepreneurs to successfully invest in real estate. He's passionate about helping and professionals to collaborate and adopt best business practice and use technology their businesses, and therefore assisting us as well as you as the real estate investor. So Neil, thank you so much. Appreciate your valuable time. And Neil's topic tonight, as we earlier saw, will be talking about the real estate market at the moment. What is it currently looking like? Thank you, Neil, so much.
Thanks, Daniel. Just want to check in with you. Can everybody hear me there? Daniel, do you want to maybe just give me a sound check that everybody can hear? Is it all good?
Neil, everybody can hear you clearly.
Wonderful. Great stuff. Good evening, everybody. Wonderful to meet you all. Pity I couldn't be there in person. Ek is 'n Kaapenaar. So I've actually in the Eastern Cape today, and I've been, strategizing with the real estate company. And I must say, I'm quite excited what I'm actually seeing here in the South African property market and the opportunities, despite all the news that we get. So just a little bit about myself. Daniel gave a little bit of a brief intro. I mean, obviously I've got a media background, and during that time I became a part-time real estate investor. And then in 2003, I bought shares into an advertising agency, and I rolled out Remax into South Africa. So that's when sort of the property bug really started taking me, and really taking it sort of to the next level. And through that, I also expanded my sort of property portfolio. I invested in the Western Cape. I also invested in Pretoria, in Johannesburg. And yeah, both in residential, commercial property. Got a lot of experience. I'm really passionate about investing, and I thought, well, these little bits of success, and before that, I made sure I was very well educated, and I did worldwide trips into New Zealand, to Australia, to the US, to the UK, to meet all the property gurus of the world, and really to find out why, what is the success, and what can I take from that, and how can I share that message to everybody in real estate. And yes, and I met, through Dolf de Roos, and Daniel mentioned that Dolf he's actually from New Zealand originally. He's Dutch descent, Netherlands, and he invested quite heavily in real estate in New Zealand, and he bought his first property when he was only 16 years old. And in fact, when he got his first mortgage, the banker thought that it was a hoax. So yeah, he managed to still get it, and because of the numbers, he managed to put it into an entity and get his first property. So I've learned so much from him. He eventually became the advisor to Robert Kiyosaki, and I've just learned from all these people in the industry. So 2005 and 6, I met a gentleman by the name of Andrew Waite. Andrew was introduced to me by Dolph in Phoenix, Arizona, and they had a magazine called Personal Real Estate Investor, which was in the print form. So I thought, well, why don't we do this to South Africa? Why can't I bring this to South Africa? In Australia, there are 3 magazines. In New Zealand, they had 1. I said, South Africa deserves 1 too. And so that's when I launched Real Estate Investor in September 2007, and it was in a print format. And we've never turned back. And then, of course, COVID came in March 2020, and unfortunately, we had to go to print. But the digital sort of market had really grown to a big strength, and I think it was probably fortuitous that we decided that digital is certainly the way to go going forward. So we do a lot of webinars on training and that kind of stuff. So why am I here today with Daniel and his team? Because first of all, I think Daniel's very professional. I think he's adding a fantastic service. He's bringing lots of value to investors out there. And I think most important, if you can get value and if you can get return from somebody who's a trustworthy supplier, then I would suggest go ahead and use them. So Daniel's asked me to talk a little bit about the South African property market, which is quite interesting because there isn't one South African property market. There's very different and diverse markets. And we don't want to go into anything political, and I would say that to everybody, try and limit the amounts of bad news and information that you receive, because don't get into that News 24, that Netwerk 24 app too much and get sort of hourly updates on kind of what's happening. Because today, in fact, very interestingly, I think I was with quite a few farmers who are out in the Free State sort of area, and who are quite positive about what's actually happening here in South Africa, and also in Port Elizabeth area, and also in Gauteng, areas of Gauteng as well. And it's quite interesting that, remember, when there's blood on the streets, there's major opportunity. Eventually, private sector is going to come in, and I think that eventually, this is going to create massive opportunities. So what's happening in the market? So we've seen massive semigration trends. We've seen people move from Pretoria. We've seen people move from Gauteng. We've seen them move down to Cape Town, simply because they're not getting the services that they deserve up north. Potholes, and obviously excessive no water, electricity, and various other services, and also excessive rates and taxes, and just the whole management thereof. So this has forced a massive migration into areas like George, into Mossel Bay, even into KZN, certain areas of KZN. But Western Cape is definitely one of the areas that's benefited the most. And I've worked quite closely with our mayor, Jordan Hill-Lewis. He's doing an absolutely fantastic job. And they are so driven to service and to do delivering to the ratepayers. And they have a 2-week turnaround time that if any new property developer wants to put up a development, they've set themselves a 2-week approval process. So there's a lot of things, a lot of good things that are happening, and they really are sort of setting the trend. So first of all, we've got to look at the whole Western Cape migration thing is only a trend which is not going to last around forever, because the Western Cape, unfortunately, the market is only so big. It's not a market that can sustain so many people. I mean, the population growth has been excessive, and of course, anybody that's been on the Western Cape roads will see that certainly the traffic has increased significantly. So what's happened is it's driven the rental market up, the short-term Airbnb markets. They've all gone up. There's a massive demand. Property prices have increased, and this is what happens. It's a supply and demand situation over here. So really, what's happened is that We're sitting in a situation where everybody wants to get a piece of the action, but what's really happened out in Gauteng is that a lot of people can't sell their properties as quickly as they would like, because all of a sudden in the north, everybody is trying to get rid of their properties. They're trying to get out the market quickly, and so therefore that has driven a lot of interest into the rental sectors. So this is a trend I think that's going to carry on probably still for a while. And we're also seeing, we're heading off to an election here next year, and we're seeing government who is obviously, they've just given a 7.5% rate increase to public servants, which is really saying that we want you to vote for us next year. And it's going to be really interesting to see how the whole sort of political thing rolls out in the coalition, because we obviously seems we're heading for a coalition situation. And we've seen, obviously, and this is not a political discussion whatsoever, but really what I'm trying to paint the picture, and I don't think we should be too concerned, because the private sector is going to benefit, certainly from the non-delivery from government in most of the sectors. So this is opportunity time, I can tell you right now. So you just need to find the pockets of opportunity, and all I'm really trying to say is keep your eyes wide open. There are some people that are struggling and in the distress sector, and I think this is where Daniel offers great opportunities. He calls it impact investing, and really it's an opportunity to help somebody. And really to lead them in their home. So, but also to offer you investments that can give you a really fantastic return. So I'm not here to say where and what and how and where you should invest. I like to engage with the crowd. So if I was there tonight, we would be talking to each other and really to engage. What is it that you want to hear? And it was quite interesting. Today we've actually got one of the senior executives from Absa. He's talking about all the finance and what's actually happening in those sectors here. I'm sitting here in Port Elizabeth, very interesting, just to find out, to keep up with these trends. And I'm fortunate to be able to be up to speed and also to report on this in Real Estate Investor. So I could really carry on for quite a while. But what I want to do is I want to leave you with something positive, because I think it's very important. Some people look at this and they say, is there hope in this country? We're seeing a lot of people leave. I mean, I've lost family members, gone overseas. I still believe they made the wrong decision. Things could turn around, and I think when they turn around, it's going to be fantastic. And I think there are more opportunities. And I think in South Africa, there's more going for us than not going for us. If you look at the price, the cost of living overseas, you cannot have the lifestyle that we have in this country anywhere around the world at the prices that we are getting it. And that includes real estate. Because just remember, everything is linked. Remember, when property prices or inflation goes up, real estate exceeds and above the inflation rate. So it's always a longer term game. So 3 things I want to leave you with, just as a bit of positivity. And that's for everybody, whether you're running a business or whether you're investing. The first thing is, I'd like you to say is work harder. Because if you don't work harder, hard times will come to you. It will come to you in any event. So put your effort in. The other thing is, while you're actually doing that, while you're working really, really hard and putting in your effort, is to have fun along the way. And I think that's so important, because if you're not having fun, what is really the point? And then the last thing is, and it relates a lot to Daniel's business, to Wealth Assist and Real Estate Assist, which are doing fantastic work, and that you have to, in some way, you've got to give back. And, in this, I just think we still live in a fantastic country. I still think we've got, there's more things to be positive about. Please don't consume too much of Netwerk 24 and News24, guys. It can destroy you. I'm not saying stick your head in the sand, but keep it to a minimum. If the news is bad enough, as they say, people will tell you about it. I think I'm going to end off on that, Daniel. So baie dankie. Ek sien jy staan daar voor met die microphone. I'm sitting here with a whole bunch of farmers out for this side. They are positive. They are in a massive growth trajectory. you know, and it's unbelievable. You know, I found out today that 20% of meat is produced on this continent, in Africa, in South Africa. So, I mean, what a food chain that is being produced by our farmers, and they're doing such a fantastic job, and they're adding so much to our economy, and they're such a stronghold in that economy. So I'm just going to end off on that note. Daniel, I hope I've covered anything. I'm here. If there's any questions that you want to take from the floor, I'm happy to answer one or two, but I know you're following an agenda, Daniel, so I'm in your hands. Thank you very much.
Thank you, Neil. I think let's see if there's any specific questions, guys, and even Gerard, you guys. I think we've unfortunately missed a part here from our side where it dropped the call for a moment. But I'll obviously send the recording around to the guys as well, if it's okay with you. So any questions? If somebody got specific questions about a few things that Neil spoke about, and those guys online, please, if you have some questions as well, please go ahead. Where's that few talkative clients of mine? That's not so quiet here, guys. Neil, just from my side, whilst giving somebody else an opportunity, I think a very important part is if we look at the residential market at the moment, and we look at the statistics, and I don't want to go too much into that in the detail, but the principle of any good investment, and I always say that good is the enemy of great, but for a start, it needs to be good, okay? And for your current guidelines, if you look at a direct real estate investment where you invest in a property with a purpose for buy to let or whatever your plans are, the minimum kind of guideline would you think that your returns should be in the range of?
Well, Daniel, it's a great question, and it's also a very difficult one because you've kind of thrown me under the bus, but I always follow Dolf de Roos's message. And if you follow these guidelines, you could never, ever, ever, but never, ever go wrong. You always make your money when you buy. When you buy your property, that is when you make your money. Now, you know, a lot of the times, and I'm not saying that you mustn't buy new developments because there are opportunities, because they have massive capital growth opportunities. But, you know, I look at some of your investments that you offer there, Daniel, which, you know, are not easy to find. Because the most difficult thing I think that a lot of investors have to get over is to say, first of all, if I get presented with a deal, is this a good deal? Do I trust Daniel? Do I trust this person? And in most cases, a lot of the deals that are presented to a lot of investors are not good deals. Now, I'm not going to go run into like a series of numbers or anything like that, because I know all the best investors in the world, including the Dolf de Roos's, the Robert Kiyosaki, and even my good friend who passed away who bought the Canal Walk Shopping Center, used to do all their deals and calculate them on the back of a cigarette box or on a piece of paper. And you got to first of all look at it. And I think the deal is got to be in front of you. I always say, if you're going to make any investment, don't just purely do it. You can buy online. I have bought investments in the past purely online because I had to jump in first, but you can put in your offer and then you can revoke that offer. So you have an option over there. So at least if you put it in, you can say, well, subject to whatever it's subject to, and then you can walk away from that offer. But certainly, I think, you know, you got to get a feel. The numbers is not something, you know, you can look at the property and say, well, how can I create it into something different? And that's what it really is. It's a creativity. So I'm not going to say anything more than that, Daniel, because it could be a whole big long discussion that we could get into.
No. I appreciate that, Neil. I appreciate that. I've got another question here online. I was in PE the last weekend, saw residential developments all over the place. What is driving that in PE, seeing that you just been there?
Yeah. Look, so I mean, in PE, it's a very different market. There's, I don't think, if we start looking at the South African market per se right now, the only market that's really performing is the Western Cape, and PE, unfortunately, is also driven by. And let me qualify that because it's very important. You know that there were 170,000 jobs created in South Africa between October and December, and also between January and I think February as well, mainly driven in the tourism sector. Of those, 167,000 jobs were created in the Western Cape. So the 3,000 was the rest of South Africa. So that just gives you an indication. So where there's obviously employment opportunities, that's when people are thriving, and that's when they can take the extra money, invest, and which is fantastic news. So if you look at Port Elizabeth now, Port Elizabeth numbers, and I'll talk about the Eastern Cape. If you look at the house price index, it's increased by, I think it's 8%. Year on year, which is fantastic, and you do find that happens. So I think the most important thing is, if you're going to buy in Port Elizabeth, you've got to say, well, why am I buying in Port Elizabeth? Is there a specific reason? I always say, ver van jou goed na in jou skade. You've got to be close to where your investments are. And I rather suggest, if you're living in the Western Cape, rather keep it rather closer to you. If you're living in Port Elizabeth, you could also do really well. So, my suggestion is, yes, there's opportunities in every single province. You've got to be the one that is walking the streets, that is checking to see whether the deals are there. However, if you start looking at the fundamentals of the general market, it's not as strong as it is in the Western Cape. But what's happened is that the prices have gone up significantly higher. It's become unaffordable for a lot of people. So yes, I would say yes, but be careful, find out your reasons. If you live in Port Elizabeth, I would say, why not? Just do your inspection on the developer and where you're buying in the area, and also the future job, because I know Coega, which is the harbour development, they're sitting there with a massive opportunity. It's going to take a couple of years before they start getting that going.
Thank you, Neil. Thank you, Neil, so much. Appreciate that.
Thank you very much, everybody. Thank you, Daniel.
Great stuff.
Lovely speaking to you.
I'll
Thank you for the opportunity. Cheerio, everybody. Bye-bye. Have a good evening.
Thanks, Neil. Right. Good. I'll try and catch up. And for me, that's a very difficult thing. So I'll do my best, guys, to try and finish as quick as I can without skipping the important parts, because that's why we're here. So what does our company do to anybody else? Now, when Neil ended off is actually where I want to start and say, with the real estate investments at the moment, I see Neil obviously with the right reasons don't want to quote what is a kind of a good investment in real estate. So the methodology that most of us know is, let's buy a property, let's keep it. If we keep it long enough, pay it off quick enough, it can provide a passive income for us one day. And then we buy the second one and the third one and the fourth one. And so we build up properties to actually give us a passive income in the future, it's a brilliant idea. And it's substantially at this stage and proven over the years that it's actually a substantially better method, looking at security for your capital, as Gerard have spoken about, that you can build your capital and growth. And online is people that, without our involvement even, have built up those type of buy-to-let opportunities over the years and up to this stage. I call it a good investment, okay, because I'm going to give you some secrets today, which, my dad was in property all the years, and he taught me one lesson from very small. He said to me, he had this picture, and he always showed me this picture of this old man whose beard was hanging on the ground, and he had a kiri in his hand. And he said, this is the young man who waited for the price of real estate to come down. So yes, it's definitely true that prices, and especially in South Africa, where we got undersupply of properties, we are more than 2 million properties short in this country to people who actually need homes. Okay, so there's quite a large opportunity. Does that mean that every property investment is going to be a good one? No. Okay, so, and that's what we are doing with our services here. And I'm going to touch on a few keys here that we have to look at. So number one is obviously, if we look at the disrupting process here, what are we doing different than anybody else? Okay, first of all, we don't do buy-to-lets. We do it. We do it for clients who wants us to research and make sure that we give them a good buy-to-let. Okay, and if we provide you a buy-to-let, 99% they will be a buy-to-let with a positive cash flow. That means even if you took 100% mortgage from day one, it will pay itself. Okay, and we'll touch upon the differences between these things. But Neil touched on this as well. First of all, we look at what are we doing differently? How are we disrupting the distressed property industry? But at the same time, we are disrupting the investment market. Okay, because if you currently buy a buy-to-let, and I'm just generalizing nationally with statistics, you should be able to get a good return on the rental of about, after your rates, taxes, and everything is paid, you should end up with at least about 7% return. Okay, and then you should have a capital growth somewhere between 4 and 5%. So you should end up, in Gerard's picture, very close to the 11 to 12% kind of returns. Okay, and unfortunately at this stage in certain higher price brackets, etc., the returns or the capital growth current averages in our country is about 2.7%. In the more mid-range, you're talking about the 3.5%, and when more affordable market, then you are looking at a slightly higher rate of about 5% or 6% there around. Obviously, province-wise, it's different and all those type of things like Neil spoke about. So what we have done is said, but let us make impact and build sustainable business. And most of you know that when people are in trouble, there's a lot of guys in our country as well as other countries in the world who actually teaches people how to find the vulnerable, how to buy those properties at below market value, and then on the end of the day, build themselves up capital and riches. Now, for me, I was a guy who used to go to auctions, bought auctions all my life. And after about 5 years, it took very long for me to get the wake-up call, looking into other people's eyes and see how I decided that this is not a good thing. You can make so much money, so you're getting up every day just for that purpose. And as Neil said there, the great thing is find something that makes a difference. And I made that call to say, I'm going to change this. I'm going to do something different. I'm going to help people. But at the same time, and this is the key, currently we have about 46.8 billion rands of residential house mortgages, bonds. That's more than 90 days in arrears in this country. Okay, so is there a lot of demand of people that needs assistance? Yes. Okay. So secondly, we have investors that has got a challenge with what Gerard spoke about, is they have the challenge that they can only earn returns of 7-8% if they're fortunate. You know, we have to change that. We have to give the investor the opportunity to actually have a higher returns. We have done in a combination. Okay, so we have these products that we designed that helps the client on the one side, but at the same time also assist the investor to make a return substantially higher than the norm in the real estate investment market, and specifically the residential real estate market. Okay, so that's what we do differently. We're saying here we do it the different type of products that we're just touching on here. I don't want to go into the detail now, but we'll touch on one or two of them through the later in the next process. So providing, first of all, our returns are in the line of about prime plus 6% or higher. And here's the big difference. First of all, when you buy a property today and you rent it out, you don't have a predetermined return. You have got a specific rental that should fetch in that market a certain amount. So call it R1 million. You maybe can, to get a 10,000 Rand rental a month, then you have to deduct your rates, taxes, levies, depending on what type of property you buy. And then you'll end up with 7,000 Rand a month, for argument's sake. Okay. And at the same time, you hope that the growth in that area, as Neil said, you selected the right area, you've researched it properly. Maybe the agent gave you a bit of a wrong idea of the valuation. Things happen. Okay, so if we move to the next one, the third point, on the shelf, pre-vetted, risk-mitigated property investment. So when you go onto our website, we will, on the end of the day, do, and this is my key. I want to ask any of you online, any of you who sit here and are currently working, and even if you start getting to the point where you want to retire, and you have to go and learn, and I don't misunderstand me, I don't think I know, but I've been in property in the region of 39 to 40 years. In the real estate, the stressed property line, about 25 to 29 years. If we look at that combined with our other team members and the people that we've got in our group, we are here to help investor. When will you knowledge? You understand? It's a question of there's so many years that you've got, okay? And as Neil said and Gerard said, you work hard for your money till that stage. And some of us work 30 years, and why would you just throw it away? Okay. So align yourself with people. We are a real estate investment advisory. That is what Wealth Assist is. That means just like as you have an insurance company doing what you have to do on the end of the day in insurance, you don't rely on some guy to give you advice about investment. You use the financial advisor. That's why you got a Walter here, and he actually made the effort to get you here. Okay. So that is the reason for it. And what we do in these transactions is we literally do all these things. We make sure that, and Neil touched on, we make sure that we procure to find them. We know where the people come from, that they are looking for help, and we assist them in that situation. We do all the risk assessment. We do the maintenance quotations upfront. We property management. We do the whole process in that cycle, literally from the day that your investment starts till the day that you exit that specific transaction. So, and here's the big mind shift, which is the biggest. I've grown up, my father told me to buy property and keep it. Okay, that is a good investment. Okay, and if it gives you 12%, you're doing okay. All right. You're not going to make a lot of money, but it's going to be okay. But if you can make the mind shift of is the vehicle or your asset, but it's not there to keep you. The purpose is to use these investments, do a cycle with them, sell them and get the returns, and reinvest that returns. And I'm going to show you now what difference that will make for you. Okay. So we just, property stays the vehicle. And you'll see when we talk about the products. Now, if a person invests in a buy-to-let, I have to use a buy-to-let as a comparison to our products. And you invest and you pay each R1 million. Most people who buy a property, 5% of market value if they buy a bargain. Right? I'm talking about specifically new developments because that's what people sell them. There's 95% buy that new development, they pay 95% of market value, get a good return of 7% after rates and taxes, everything is deducted. Maybe if he's very fortunate, he get a 5% capital growth and he ends up with 12%. Okay, so if all can see the slide, so here you'll see that we talk about an investment of R1 million, just to use round figures and make it simple. If you buy a buy-to-let, you buy, I think you probably get it in 95% of market value, or at least that's what they tell you. Then you get a yearly net return of about 7% per annum after rates, taxes, levies, etc. You'll have a capital growth of call it 5%, so you're making 12%. So in that bracket where Gerard was speaking about, that it should be a good investment. Okay. So, but now you keep that property, and here's the difference. Okay. We buy the same property that's just worth 1.3 million rand for R1 million. So immediately, remember what Neil said, immediately you have that capital security already built in your transaction. And that is what actually secures your return, is the price that you pay for that property. The interesting thing is on your 95% one, you still sometimes have to pay transfer fees. If it's normally a development, is included, but you'll still pay your transfer cost or your bond fee. Okay, so if you compare the two, you bought for the right price. Now, just to simplify, I know here's a lot of figures here. Let's not focus on that. Let's focus on this. Okay. So you'll see the total recovery and capital growth. So what we do is we buy this property from Mr. Joe Soap, who's in trouble. Okay. We pay for that R1 million property, or for, let's take it the other way around that we just spoke about. We buy that property for R1 million, but it's worth 1,330,000 rand. Now we take him through a process where we recover him financially, making sure that he fixes his life, his finances, and he repurchases his property. Now, let's say take him 2 years. Okay. And the returns that you have received, you are not spending every month, because both of these transactions we have done as if all the money is reinvested and you're not living even from it. Okay. So in the top one, you'll see that after 2 years, this client buys back the property. Okay. Now let's say, just simplify it, they make 18% a year, R1 million. How much is 18% per year on R1 million? 180,000. You agree? Okay. So then you must make the sums with me, Walter. See if I don't cheating here. Okay. Then the second year, so 180 and 180 is 360. Yes. Okay. So we've got 360,000 rand profit that we made in this year. These 2 years. Okay. Now the client buys the house back, and you're going to do another recovery. Okay. So how much money do you now have to reinvest? Help me, guys. Come. 1,360,000. Okay. So here's the thing. We are investing 1,360,000. Now the difference is, if that is what you're reinvesting, what is your returns going to be calculated on the next 2 years? On 1,360,000. What is Mr. Buy-to-Let's property growing with? Invest the 7,000. He first have to sell his property to reinvest that money, to have a capital growth on that. Now, I don't want to go into all the detail, but I'll send these through to you. Here's the difference after 10 years. And this is what it's about. Okay? So we are not doing, or like most people say, yes, this is too good to be true. There's no funny thing about it. Okay? The only difference is we don't have to hold on to the properties. We just still do property investments, but we just don't hold on to them. Okay? Even if you get a rental income, you reinvest that, where will you end up? There will be a difference between that figure there and that figure there with the same R1 million. And the simple miracle is it's compound interest. Okay? On your return. So it's compound returns. Okay. Whilst if you just rent it out, You're only getting the monthly rental income. The capital growth you will get one day when you sell that property. That's all when you're going to get it. Okay. So if you tell me, and this is most people's kind of challenge for me normally, I say, but I want to own it. I want to have this property and I want to rent it out. I said, great. We can still do the same. When do you want to retire? 10 years. Okay. I'll buy you 4 million rands worth of properties in 10 years. And because I probably have the cash, okay, to do that, I can buy it substantially lower than market value. Much better than 2.7 million, where this client has ended up at. And that's the simplicity of what we do, okay? We're only doing compound returns and obviously predetermined compound returns. Now it gets a bit more exciting. So we talk about this, if you compare it to a buy-to-let, it's a buy-to-let plus plus. It's on steroids. Okay, and I'll explain to you why. All right. So what we do is we've got two lines of investments, mostly. Okay. The purpose is helping people to keep their homes. Is the motivation why we're in this business. All right. So now Mr. Joseph wants assistance because he's made some mistakes in his life. He too much short-term debt, this, lost his job, trauma, whatever could have happened to this client. Now he's busy in the process. He's recovering. Now we have to sort out. Now, but where will he get the salary to pay for all the arrears at one time? He doesn't have it. Okay. And he probably short-term debt quite a bit to cover his bond or other things and payments that he had to make. Okay. So what we do in those situations is then we'll help them. You will buy his property at a certain price. Okay. And we'll sign a lease with him and help him to walk that road with him. We call it a financial wellness program, what we call, where we put him through making sure that he recovers within the time. We actually check all those things up front, make sure that he can qualify for a mortgage when that time he can recover on his current salary. We even test it with two prime points above prime, 2 percentage points above prime. So if the current rate's 11%, we'll do a test on 13% if he qualifies, because we know interest rate can rise. Okay. So all those type of things are taken in consideration. Jy moet net vir hulle vra as ek gaan nou gap gee om te praat. Yeah. Okay. So we will give you guys a gap now to get some of that questions in. Just see if I don't answer it in the next slide. All right, so then we have those clients that apply. 90% of all. Is everybody able to? No. Okay. And we're very honest about that. If they are not recoverable, that's why we got the second line of products, which is called the on-sale products, which you talk about as flips in the industry. Okay. So if a client can't recover, then we'll do a flip with him. So we'll stop the legal action, making sure that we can actually sell that property, fix it up, maximize the returns on that. But you as the investor as well will make that returns. Okay. So the first point is that the distress, so we're going to tonight, if we look at and capital growth products. We're not going to spend, we have other seminars on a monthly basis. We're going to discuss the other products in those sessions. But tonight we're spending time on the recovery product and take it from there. Okay. So the distressed real estate owner will then sell that property, and we have then the property as security. You'll transfer that property in your name, or if we do what we call a alienation of land act transaction, or a hire purchase, or whatever you want to call it, installment sale, then in that case we'll do a recordal over the title, but you will always have that security of the property. Or if we help a client who's got enough equity and all those type of things in his property, and he can only do covering bond, then we do a recovery bond, what we call, and we assist that client in that way. Okay. When the tenant trusted to improve his credit score, as I said. We touched on that. The tenant qualifies for a bond, and then he will repurchase that property within that 24 months. Our average is about 20 to 24 months. Obviously, clients that can do it in earlier stages and so forth. And we've got unique contracts. If a client pays in time, we motivate them. If they pay before the 1st, then they get a discount on the rental. Doesn't come out of your money, so don't worry, it comes out of ours. And we also, part of our profit share that we get, they get a discount if they can recover in time or actually prior to what is anticipated. Okay. Good. So let's jump into what is the differences. And the only way, I'm not trying to downplay a buy-to-let, guys. Please, I've got respect for buy-to-lets. Will give you that product as well if you're really desperate. But if you understand the difference, sure you'll consider or really think about it twice before you do that. So first of all, on the recovery product, this client is somebody, he lives in that home and he wants to keep his home. That person is just totally different than a tenant. And I'll explain that in a very simple example, what happened, as we all know, in COVID time. People's salaries dropped, things happened, drama was there. Problems was with tenants. A good standing for tenants, 83% to 62%. Okay, massive drop. Okay. On our people that we were busy in our recovery process through the whole of COVID, we had a 7% of our clients that was paying late. Only one client agreed that we must rather sell his property because all the others was just an extension of time, most of them 6 months, and they all recovered after that. Okay. So, but what's the difference? The difference is that guy who stays there, he sees himself as the owner and not as the tenant. Because it's his home. He still thinks it's his home. Because he's got a first right of refusal to actually buy that property back at a reduced price. Okay. All right. So then second one you got is the predetermined prime plus returns, which we spoke about. If you work on a buy-to-let, you have got hopeful returns, which you can estimate, but you don't necessarily can see what the growth is going to be. Here, it's predetermined and it's contractually predetermined. Then here is probably the biggest, one of the biggest advantages where we speak about the triple net lease. I don't know if you know what it is. Any lease tenant will pay the maintenance if there's maintenance. If the rates and taxes go up, which we have seen over this last few years drastically happening in South Africa, okay, then the tenant pays. When the interest rate goes up, like it did, the 4% over the last 2 years now, you as the person as the tenant pays the higher rental in line with it. Okay, you will never get that in a buy-to-let. Okay, or you probably won't get a tenant. You can try it and put market for that. But why is this person prepared to? He sees himself as a real estate owner. He doesn't see himself as a tenant. Okay, he sees that he's given an opportunity to actually just buy his house back. Okay, whilst all those expenses on this side is the expense for the landlord. Okay, when the interest rate comes, you can, but you'll probably sit with no tenants. Okay, then on default, what happens on a normal buy-to-let? What happened in COVID? It's a good example. Okay, if the tenant then has problems, when all these guys that's on this, they can tell you, most of them owns lots of property. Okay, some of our clients online here, and they can tell you the biggest headache we most have with property investment is either the overturning of tenants, where you have to do maintenance and things to catch up that property again. And if you catch the wrong guy, unfortunately with a tenant, and you have to get him out, and you have to spend your money getting him out, it's a challenge. because the eviction will start at 50,000 rand at least. Okay? That's where you're going to end up. All right. So that's the risk of those kind of investments. And you have to consider those things. Now you'll ask me, but why wouldn't it happen to your client? He can also default and he can all do all those things. Yes, he can. But here's the difference. You've got 25% of that market value. And here's where the big secret lies. If any client in this process defaults, let's say a guy goes well, after a year he loses his job again. It can happen to anybody. Okay? What's happening with a buy-to-let tenant and what's happening to the recovery client? Recovery agreement with us is, in that case, we first of all have a 3 months on-trust deposit to cover you while we're doing the sale of that property. So we will meet with the real estate owner, we'll agree on the way forward, and we'll agree that it's, in actual fact, the contract states it, that the property will be sold. Now let's take this property of 1.3, which you have bought for R1 million. Okay. Now, if that property now sells, what will happen with that money? Okay. You've done a deal. That property, let's say it's only grown by 5% a year. So on 1.3 million after a year, we'll have another 78,000 rand. So we'll be at 1.4 million. Okay. But you've only invested R1 million. All costs inclusive. Eh? Transfer, everything. Okay. Now that property gets sold for 1.4. You put your capital first back, then you get your predetermined profit. Remember, you've got now your monthly rental for that year. Okay. So you've received it. It's only after a year you now lost his job. Okay. So already a lot of your income has already been generated and your risk is mitigated. That now he runs into trouble. Now you first have another 3 months covered already, right? While we're selling the property. Now let's say it takes 3 months to sell it because the current average timeline is about 75 days to sell a property at the right price, okay? But at this stage, we're expecting it to increase slightly, so it will take 100 days. So let's call it 3 months, 3.5 months. Now you have another 2 months for transfer, so you may have 2 months of rental income that you don't get. But if it is sold, first of all, then we cover that with, we ask the cancellation, pay the mortgage after the 3 months, because then the transfer process starts. And you will be covered by that. You don't pick up a bad credit record. We've done it quite a few times. Okay. So if that is the case, that you are now in that position, is another 3 months in arrears before we actually get it sold. What happens then? Then there's 25% between your 1 million plus, let's say your profit was 5%, your million, so that's 50,000. So there's another 350,000 minus the agent's commission that is available to secure your returns. And Assist Group takes the returns, but whose returns are they taking first? Mine. Okay, we put our money where our mouth is, and we're saying, if for some reason we're getting less than what we set the values, things, they take my money first. Okay, so you are well protected in that. And here's the big secret. If we sell that property for 1.4 and you got your money, you got your 50 grand, that's your profit, okay, for that first year. The income which you already got, which is by that time, call it another 100,000. So you're sitting at 180, okay, that you've received then in total. That means there's, call it 200,000 left. Okay. So who gets that 200,000? We get a very small part of it. The rest go to the real estate owner. So he's motivated to sell that property if he's in default, because he still gets a lot of money out. We're not going to kick him while he's down. That's exactly what makes us different with most other people doing things like this, like where the benefit comes in. You're making excellent returns. You have a property at 75%, if it's that much. Sometimes our average is actually 65, not 75. So if you take all those things in consideration, it's a no-brainer. I think you can understand that. And if somebody tells you, I've shown you the practicality of why it looks like it's too good to be true. Okay. And just by the way, when people tell you it's too good to be true, I'm like Neil there. I'm a positive guy. The Bible speaks about 30, 60, and 100-fold return. So are we going to say that's too good as well? You know? So look at that. Good. Here is actual returns over the last, I think, 7 or 8 years or whatever that is. We'll, on the next slide, hopefully have the new stats for the last year as well. You will see that the returns, lowest returns ever, was 16.59% at any stage. Okay. That should give you comfort that if we're doing that for the last 9 years, I'm sure we can kind of try to do more or less the same. Okay. Good. Investors protection. I'm saying addressing the fears of real estate investors. Hopefully you don't have fears. You just have concerns and you want to make sure that you are very, very well protected. But if it's a fear, let me address it for you. Okay. What have you got as security? That's the first key. Either the property is on your name, or you got a recordal over the title. That's like the same strength as any transfer in your name. All right. In actual fact, in certain cases, having a recordal over the title offers better security when the guy goes insolvent. Okay, things like that. All funds are payable, obviously, into the attorney's trust account. No money flows through any of our accounts, goes straight to trust account, and that is covered by Fidelity Fund Insurance. The money in the runs, you are protected. Okay. Then maximum exposure, as I said, the fact that you buy as low as 75% of market value, all costs inclusive, or any lower percentage, it means that you actually have got security in the equity of the property or in the value. Okay. Property owner and transaction due diligence. Every single transaction, which I'll touch on now, what is that due diligence? I will explain to you. All transactions are audited on completion. For us, it's very important because when I give you a document at the end that's saying you've made 18.5%, you will sign it off because the auditors will check it and make sure that that's what your returns are. And we will never finish a transaction without you signing off the documents, and we won't pay you until you sign it off because we want to keep that track record of our performances to every single client, bad or good, doesn't matter. Okay. Solution and Investment Committee, we've got specialists sitting on a committee. They approve these transactions. For instance, on our institutional investment side, we have people who is funds that look at our risk committee research. And if they approve it, I'm sure you guys will be happy. So then contractual predetermined returns, we spoke about that as well. And insurance coverage, which that client jumped the gun and helped us to understand a bit more around the insurance side of things. So insurance covers on both of the parties. And this is where the key stuff comes in. Maintenance specialists, okay. Structural property inspection. Every single property you will be able to access online, a full-on property inspection done by a specialist, national. You will have a full compliance certificate, quotation upfront, not, let's guess, it should be so much. Okay, those type of things doesn't work. Okay. Maintenance quotations. We will always, if it's a recovery, do what we call critical maintenance. Maintenance is something like the geyser is not working. The bath has got a hole and the people can't bath. You know, it's like those type of things. If there's a leak in the roof and it's going to damage the property more, we'll fix that. Okay. That's critical maintenance. But the quotations will be there. And if it's will be at least 2 quotations. If it's above 50, lower than 250, 3 quotations. And above 250, we have appointed project managers that we appoint that will do that maintenance to make sure it runs smoothly as it's supposed to. Then plan, every property needs to have a plan, and unfortunately the whole municipality approach for nationally at this moment is they want to see plans that's online, so we make sure that the plans are compared to the current plans, and then we'll fix it if it's not. The property itself, what is the security in the property, what is the security with regards to the surroundings of the property, etc. Property specialists, what we do there, suburb actual sales, comparable property sales, area specialist assessments, professional valuations on every single transaction, and a comprehensive property report that we take in consideration before, because you don't know what developments are happening next to you or there or that. A lot of people don't even research that. Okay. What if there's a new road coming past you? You think you're going to struggle to sell that property? Definitely so. You have to take those things in consideration. Okay. Then juristic, legal, if I can call another word, legal owner research. Okay. So we check the guy's FICA, owner, company research, if it's a company. Then we look at the solution. So the attorneys look at the solution and see that it's within the laws. Rights clearance, they ask the rights clearance cancellation figures prior to doing the transaction, not only afterwards. You will know. They give you estimates, and then you find out there's 2 accounts. And then you get a good surprise of 30,000 Rand or so. So, and then obviously the standard governance we go through. Then on the property itself, additional properties owned, we see if that specific owner has got other properties, is there other risks about liquidations, all those type of things. Title deed researches and restrictions and endorsements on the title deed. You know, you can buy a property and then they say that you can't actually, you maybe bought it for subdivision or whatever, and then it says you can't be subdivided without. Exactly. Like if that's on the title, that's on the title. You need to research the title deed. Okay. And then your property related risks, other risks around the property itself. Okay. So these days I need to see is it what's municipalities such. Actually, we had a situation where we took, I think it's actually longer, but let's say 8 months to get a rights clearance certificate. Lady Smith, just was closed. The gates were locked. We couldn't get a rights clearance certificate for 8 months. So if you buy in those type of areas, you're going to have risks. Okay. This was fortunately a client that asked us to, he wants to help a family member, but in a proper manner. So we structure it for him, and we do that as well. Great. Financial. We look at his credit, existing mortgage details, affordability assessments. So what we do with a client, we look at his current status, what is his case status during the term, and what is the status at the end of the term. If it's not good, and if it's not better and it's not increased, we won't help the client because he will be unhappy. So that needs to all work out for a client that we can actually assist him. He obviously have to have affordability, and he must be able to recover, and he must have a willingness to want to recover. That is very important. Okay. Then investment, on the investment funding side, that's where Gerard and them on the credit risk committees look into the feasibilities. Is it actually executable? Research the security and return on investment. They are looking at return on investment as you as an investor and say, 16% okay on this deal. No, it's not good enough. Okay. Let's push it up or whatever the case may be. And then the risk rating in relation to the exit strategy. Guys, this is the key. In any property investment, if you buy something that you can't sell tomorrow and make your capital back, it's not a good investment. Okay. That's just for a start. And that's what Neil also touched on in the beginning. So your investment funding goes to an attorney's trust account if you do have cash. We call it a deposit holding attorney. It goes in his trust account. It's in your name. It's a market link account. Okay. And as I said, it's protected by Fidelity Fund Insurance. Then in the case where the transaction is now allocated, when you selected a deal, so while you do the deal, waiting for the deal or doing the deal or thinking of the deal or whatever, then the money will die, you return. At the moment that you select the transaction and the transaction proceeds, the money goes to a new matter statement. Okay, or to, if it's a different attorney that is the transferring attorney, then it will move to that transaction. Okay, then it will be paid to the conveyancing attorney, pay the people and take transfer of the property and do whatever is required. Okay, then the day that the client repurchases the property from you, that money will go firstly to that conveyancing attorney because that's normal practice. So the same attorney will do the transfer back to you, to the previous owner. That money will then flow back to his matter statement and into your general investment account. And why are we doing that? Because now you're doing multiple deals and you don't keep track of where your money have gone and flown. So every single transaction will go through and end back into your general investment account, and from there payable to wherever you want it to be paid. And you can make a decision after you've done your first round or first property transaction or first 2 years are finished, you can take it and run if you want to. Okay, I know if you made good enough money you won't, but I'm just saying you're welcome to. Okay, so just to give you a bit of funds. So now you'll see it nowhere the money flows to us. If we got fees, the fees get paid only when the security and everything is vested in the transaction and the suspensive conditions is met. Good. Very important. Impact investment. It's the cherry on the cake, guys. This is really, really what it's all about. And I don't want to spend too much time on it, but the important part of that is the following. We're helping people whilst you're making money, because you're not misusing people's misfortune. And I know some of you may feel that you can still do those things. There's a certain principle in life, it's called sowing and reaping. What you sow is what you'll reap in life. That's just how it is. If you want to use the nice word karma, then you can use karma. The karma will come back. Okay. And on the end of the day, it's really not worth it. If you can actually do business like this, and 17% per annum on your returns, 75% of market value, addressed all those risks at the same time whilst you help another person. That is me.
So what's the next step? Thank you very much for that one. Look, for all the online people, if you registered online on our website, that is the first step. Because the minute you register, we will know about you. You'll receive an email that confirm your registration. And then while you're on the website, you will actually see that there's what we call a pre-qualification, pre-approval quick quiz. At top-hand side, click, and that opens up a couple of questions for the local people here. You'll see in the pack there is a document that actually asks you those questions, and that will give us a background on what you need to, what you want to achieve. Why in terms of your level of investment, and then right after that, we will actually make contact with you from a planning perspective, have an initial discussion, and then we go into the formal process of planning what you need. In some cases, people want to learn. We actually take them through a process and make sure they're part of our webinars, online training material, that type of thing. And then people are saying, listen, how do you get me ready to invest? Especially if you're not credit worthy, we take them into that process. And most importantly, for the investors that are actually ready, we take them in a planning process. And that's why you're going to sell your property. You position it in your plan, in your portfolio. And that's actually critical, and that's what also makes us different. So very important, get onto a website and just start the process. For the people online, we really thank you for your time, and we hope to speak to you soon in person after tonight's session. Thank you.